This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome you to tonight's session, which is our monthly open house Q&A, where if you're brand new to the Market Guys and this is your first time, what I do is I spend about an hour going through the technical signals. I first look at the markets. I analyze all of the major indices. I look at the volatility index. I then open up the floor to take stock symbols. And then we spend the rest of the time more or less analyzing the stocks that are put out by the audience. And so, again, if you're brand new to the Market Guys, sit back, relax, and don't be afraid to participate. I've always believed that the more interaction you have with the audience, the better the program is, whether you be on radio, television, or on a webinar like this. So please don't be shy. Now, I just want to say a couple of things before I get into the major market analysis. Today, Goldman Sachs did a live interview with a fairly well-known trader by the name of Paul Tudor Jones. And Tudor Jones actually traded as a member on the floor when I was on the trading floor at the time. And he told his story about how he got started. He started talking about some of the folks he traded with. He talked about his losses, how he took major losses 3 times in a row before he learned how to hold on to his profits. And it was, I thought it was a great interview, not just because he was giving out good information, but because he started mentioning names of people that I traded with as well, and even mentioned Edwardson McGee as the first book he ever read on technical analysis. And that was actually the second book that I had read. The first book that I read was entitled the Elliott Wave, and that was Bob Prechter who wrote that one. And then shortly after that, I became a sponge for the topic. I just could not get enough information about how to read charts. And then he started talking about the condition of the market the way it is and how electronic trading has really added the risk level to the overall market and to the economy. And although he talked about this with a fairly calm voice and a straight face, they started talking about the next recession. Not, if it's going to happen, but when it happens. This is something that could wind up being a global earthquake, mainly because of the derivative markets adding so much leverage to the market. And with our foreign policy, with our economic policy, and with our monetary policy, the way it's set, the U.S. could change its monetary policy pretty quickly, but that's not going to stem the panic that might ensue from such a move in the market as it's triggered by the derivatives. And then he talked about the crash of 87 and what he was doing at that time. If you've ever read my book, that was my learning experience and why I'm able to claim or state the fact that I have $1 million education. It's because I spent $1 million in losses learning about how not to lose anymore. And so what I did is I took the link for that interview and I posted it on my personal Facebook page. That's the AJ Monty page, because it didn't give me the option of moving it to a page that I manage. So I couldn't get it onto the Market Guys site. I'll try to do that later on. But if you want to watch it tonight or even tomorrow, go to my personal Facebook page. Just look for me, AJ Monty, and then it'll be the most recent post that I put out there. So again, I thought it was very interesting. I think you'll learn a lot. Paul Tudor Jones did not go to college to learn how to trade. He learned from his own experiences. And what I found to be I guess you could say, the pinnacle of his interview was when he was starting to talk about how he decided to give back as a philanthropist, and now his Robinhood project that he started years ago is now donated in excess of $3 billion to charter schools and teaching inner city kids especially how to get better grades and how to make something of themselves in life. So this kind of all ties into what I've said for many years. And it is actually the title of the last chapter in my book is that wealth has a purpose. If I had a chance to edit that book and change one word, I would probably change the title of that chapter to, or from wealth has a purpose to wealth serves a purpose. And again, I believe that wholeheartedly, that if you could focus on your actions and the process of making money instead of focusing on making the money for the sake of making money, I think you're going to have a better experience here in the market for a couple of reasons. Number one, you'll be driven by a passion to do something bigger. And number two, I think you're going to be a little bit more mindful with regard to paying attention to limiting your losses to very small amounts. And I'm going to be covering that on almost every single stock that we analyze tonight. I'm going to be showing you, okay, here's what I think of the stock, but here's where I think you need to pay attention if this stock starts moving against you. So please take good notes on that part so you can see how we're managing risk using these tools. Now I'm looking and scanning the attendee list here. I see a lot of familiar names. Paul Farley, hey, welcome. Ron, Steve, Stuart, Tom, Mary, welcome back. Joe Campbell, Texas, welcome. Herschel, and I see a lot of familiar faces too. I mean, unfamiliar, brand new folks, so welcome. And I hope that you continue to follow us month after month and even week after week as I do the weekly market reports and put those out to the general public. Okay, so enough of the interviews and the risk management. Let's get right into the general markets. This is a one-year daily candle chart of the Dow. Let me make this chart a little bit bigger. And as I always do, I leave my lines on the chart from last week's market report so you can see how this is all playing out. Now, remember, last Friday after the close, I drew this diagonal line. The start of that line is right there where my cursor is. The end of the line is right there. The end of the line represents my target price. Now, that target price might be hit tomorrow, or it might be hit Wednesday, or even Friday towards the end of the week. Doesn't matter when the target is hit. I'm just letting you know that that is the target. Now, the angle at which I'm drawing these, a lot of people ask me, well, AJ, how do you know how to project that out and what kind of angle? I've said this before, but I'll say it again, mainly because I think repetition is the best teacher. If you look at the way the market has moved in the past, you see these right here, these lines, and you can see here from this area to here, you see that, and I'm going to erase these lines right here. But you can see that when the market goes up, it generally goes up in angles that are very close to one another. See that? That's probably what, a 50-degree angle. This is maybe 50, 55. This is 50, maybe even, like around 48. But when I draw these lines, my eye naturally moves to the left side of the chart. And I try to pick my targets based on support and resistance, but I pick my angles based on the history of the way the stock is traded. So that explains the how-tos of drawing a line like that. Now, you also notice that I drew this line not as a trend line. A trend line would be connecting the lows. See, so this would be a trend line from this low to this low to this low maybe and projecting out like that. That would be a trend line. What I did instead is I drew a line more like a median through the price action to get what's called the speed line, SPEED. The speed line basically measures the angle as far as how aggressive or how tame or calm the market is in its angle. If a market, I'm going to draw just a slight angle, if a stock is going up in, let's say, a 25-degree angle, that is not representative of an aggressive market. This is going to be a little bit more tame or calm in the price action. So again, if you look back at history and scroll, you'll see that these angles are quite common. Okay. Now, another thing I want to show you is, let me get rid of this line. You'll notice that when I draw, if you look at the lines, let's draw a speed line on the way down. Okay. You see there's one on the way down. Here's one on the way down. See the angle again being very similar. But in the extreme, look at how this is a lot steeper than these other two that I drew. And if you look at the angle here, you'll notice that the angle is more severe on the way down than it is on the way up. Can anyone tell me why that is? I'll leave the Q&A box open. You can type in an answer right there, and I'll monitor that. Why? Again, I'll repeat. Why do you think that the angle on the way down is steeper than what we see in the angle going higher? Okay, I know there's a little bit of a delay, and I know someone knows the answer to this, but, oh, I think there's an answer. There it is. Dylan came up with it. He's absolutely right. And Dylan's answer is fear is more powerful, and that's absolutely the truth. There's two emotions that really drive the market, fear and greed, and it's absolutely a fact that fear is the greater of the two emotions. So when prices start to drop, you have not so much a panic, but I would have to say there's more of an urgency for people when they're getting out, because they're not only fearing a loss, but they're also fearing the loss of any profits that they've captured or realized to that point. You see, so for a lot of people in the market, let me try to get rid of it. I have a box that you can't see that's in the way actually, but you see back here, you see this took a while for the market to reach this point. This is the diamonds up there on 26,000 and change. So up until this point, all of the people who have bought in along the way on this high, they're all experiencing a profit. Whether it be realized or unrealized, they're in a profitable position. And then all of a sudden the market starts dropping, and then it breaks down below moving averages. You got these big red candles. You got big spikes in volume. Now all of these people at the top and along the way are starting to say, oh, I better get out. But I'm going to limit my loss, or I'm going to capture my profit, one of the two. So they all react simultaneously to the panic sell, or that emotional fear component that we're talking about there. And so as you look at the markets, I have to keep remembering to erase these lines, because I only want to leave the lines that I drew from last week on. So if you look at, let's say, a monthly chart, look at what we're seeing here. Since the crash of 2008, we can see right here in 2009, the very low, that anyone who has bought into the market and is currently holding on to positions from that time, almost every single person, I would say 99.99% of the people that are involved in the market, with the exception of people that bought the very high as their first position, everyone is experiencing a profitable trade portfolio or result. Everyone. So if the market starts dropping down, even if it only drops 2,000, 3,000, or if we see a major move and we see over a week's time or 2 weeks' time a 5,000-point move, a 5,000-point move is still going to bring us to 20,000, down 20,000. But all of these people could start to more or less panic. And then you have this, what's called capitulation, where the fear starts to really magnify and compound into the market, and that's when things start to go terribly wrong. And it goes back to my point and what Paul Tudor Jones was talking about with regard to electronic trading and the derivatives, because the program traders and the derivatives market, because they're leveraged, will start to immediately bail out, and hence the reason why the next big downward move, it could be the recession that throws the market into a tailspin, or it could be a correction in the market that spurs or spawns a recession. It doesn't matter which one comes first. The fact is, fear is going to come in. So that's what the general markets, that's what the Dow looks like right now, and it's pretty extreme. So I can't really blame anyone for being cautious at these levels. I am continuing to talk about risk management every single week. So that's the Dow. Now, my projection is that we could still see a rally for the rest of this week up until it gets to that target price. Okay, I don't see any questions there, but if you have any questions about that, feel free to chime in and just type it in. Now, if you look at the spiders, again, what I did is I left my lines from last week and the week before last. So if you watch my market report, you'll see that I projected the market would go up first, hit resistance, and pull back. It did. And then all I did last Friday was I added on another leg to this forecast, with my target being the highs from back here. So look what happened. Even though we were down today in the general market, there is a nice and sizable green candle. Now, again, I'm going to slow it down a little bit to make sure everyone gets this lesson. Look at this volume here and tell me, what does that mean? See, although the candle was green today, we're still down. What are we down? 57 points or something like that. We're still down, and we have a lower high than Friday, right? We have a lower high, and we have a lower low, but the candle is green. The only reason it's green is because the closing price was higher than the opening price. The closing price is still lower than the closing price from Friday. So it's still technically in a down move today. But the lower volume is giving us a signal. And Ken hits the nail on the head and says that the sellers are losing momentum. That's exactly what that means. Look, last week the volume was going up as the price was going down. The increase in volume is telling us the sellers were motivated last week. Now, this week, we have a lower volume on a lower candle. Again, that's telling us that the sellers are less motivated. Okay, so this is a sign that there's a good chance we're going to see a bounce off of that 20-period moving average, just like I forecasted. So be prepared to see that. And then I'm going to go to the Qs. QQQ is the ticker symbol for that. And what did I say? I said last Friday, we're probably going to go lower on the Qs. We did that. The volume is lower. So I'm not quite sure we're even going to get all the way my target price on the Qs. But we're still technically in a downward leg. Lower high, lower low. Sellers are still in control, but they're not in as much control as they were on Friday. Okay, so that's the Qs. Looking at we did the SPYs, we did the diamonds, we did the Qs. Looking at the Russell 2000, more broad-based index, I did not see the pullback in the Russell 2000. We did early on in the day. We opened right here at the bottom of the green candle, but we pushed lower. So it's still in, I would say, range of what I forecasted, but we did set a new high here today. The Russell 2000, this index does not measure the volume, so it's hard to compare that. So when I'm looking at the Russell 2000, it's actually a lot harder to forecast the Russell 2000 than it is for the spiders, the Qs, the diamonds, and and so forth. So you have to more or less then measure the divergences from that moving average. I was talking to my son a little earlier today, and I was explaining to him, the rubber band effect and how that works. So when you see wide divergences from the moving average, you then become more cautious as the price drifts far above or far below that moving average. So that's the major indices. Now, finally, the VIX. I projected this week that the VIX would move higher. It's still stuck below the 20-period moving average, and we had a long shadow above the VIX. So I still think that could pull back just a little bit, like I said it would, before going higher. But keep an eye on the VIX. If you have if anyone here is from the Scotia iTrade crowd up in Canada, my next web seminar that I'm giving, when is it? I think it's the 21st of the month. I'm going to be giving a presentation on the volatility index, and not just the CBOE volatility index, but all the major markets and the volatility readings on how that works for all major markets. So stay tuned for that. And I think they're going to be recording that and archiving it on their on their YouTube channel. So again, it's not hard to find. Just kind of Google it. Okay. Now, Paul has a question that I'm going to take, and then Ken has a question right after that. So I'll get to those right now. Paul says, thinking of a short time calendar trade on GS, that's Goldman Sachs, I believe, going out to 1 week from this Friday using a 30 delta for the short put and call. All right, for anyone that doesn't know options, that's going to seem very confusing. So here's what I'm going to do. I'm going to help Paul with his trade right here. This is Goldman Sachs. Interesting that you brought that up, Paul, after I highlighted their interview with Paul Tudor Jones. But what I would say is, if you're looking to short a put and a call, that could get you in a little trouble. And here's why. Because shorting the put I'm okay with, because you look like you could be forming a higher low here. And that wouldn't be so bad if you're shorting a put somewhere down below the support level here. But shorting the call, see, with Goldman Sachs, they're going to make money on the volatility of the market because they do have traders that trade and they make commissions on trades. But their money managers get pretty active and they'll start moving things around in their portfolio. And I think Goldman Sachs, what could wind up happening is all you need is a Goldman Sachs analyst to come out and say something positive and the market's going to rally. And with that, Goldman Sachs could rally. So there's ways of manipulating the market without actually being so obvious that you're manipulating your own stock. So I'm not a big fan of selling the call, but what I would think about doing is maybe doing a diagonal spread with a leap, buying a leap and selling an out of the money call with more of a directional feel to it on the upside. And so, Paul, I don't want to get too far into the details with that because I would say 80% of the people are going to get confused in my explanation. But how about you send me that in an email and I'll address it and kind of explain more what I'm talking about on that for you. And I think that'll help you. Okay. Now, Ken has a question. And by the way, if you don't have a question, start putting in your stock symbols. I see Sean, Ron are already doing that. Ken has a question. Do the same technical analysis rules apply to FX, say USD versus Canadian dollar? Yes, it does. Technical analysis is just that. It's analyzing price history, no matter if it's a stock, a bond, a currency, a commodity. It doesn't matter. Technical analysis is used in so many different ways, and all the charts are really doing for us is measuring price history. It's a rolling record of price action. And by analyzing the trend and the volume behind that trend, we can get a really good idea of where the money is moving. Is the money moving into a stock, or is the money moving out of a stock? As I was talking to Paul, here we see that the stock is in a downward trend on the daily chart. But look at this. If you look at the weekly chart, you could almost say it's in an upward channel. You see, this low right here connected to that low right there and projected out, you got higher lows on the weekly chart going back for a couple of years, and you got higher highs. So yeah, it looks a lot different on the weekly chart than it does on the daily chart. Now, with that said, I wouldn't be shorting this stock in any way. I'd be looking to take more of a long position, you see. So it applies for the currencies as much. In fact, some of you may be tracking what my forecasts have been for the Bitcoin market. I'm going to tell you right now on this recorded line, you're not going to catch me trading a Bitcoin, but I will teach you how to manage risk in it all day long. And in fact, on July 23rd, right before lunch, I am going to be talking and addressing the cryptocurrency traders in Chicago. And this is my actual chart where I forecasted before this big red candle right there, before that candle formed, I had already projected lower prices. And I still think this is going to go a lot lower. Why? Because the technicals are telling me that it's going to go lower. This is a bearish engulfing pattern that I've never seen before. It's enormous. There's gaps below the market. Yeah, there's a gap above the market too, but I think it could take years before that one fills. There's still gaps way down here below the market, right there around 2,700 roughly for the Bitcoin. So, this can be applied, like I said, Ken, to the currency market, whether it be a cryptocurrency market or a stock, commodity, whatever. You read them all the same exact ways, exactly the same way. Okay, now, Sean is asking if I can analyze AMD. I think that's Advanced Micro, if I'm not mistaken. I haven't looked at that one in a long time. AMD, am I right on that? Yeah, Advanced Micro. And if you could, just like Sean just did, if you put in a symbol, please try to give me an idea of what you're looking to do. Because remember what I said at the very beginning, I'm going to be looking at the stocks, but I'm going to also be showing you where the risk points are so you know how to protect yourself. Now, I do believe this is one we analyzed last month. And you can see that it's completely broken out of this resistance line up here. It did not pull back. Okay, now Sean, look at this. This is extremely important now that I've switched to a weekly chart. This is going back 3 years. I want you to focus on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks in a row. We've had a green candle showing for 11 weeks in a row. Look at the past 3 years. Has there ever been another time where that stock has had such a long stretch of green candles? The answer is no. That's called a stale green light. So now that we see that from the weekly chart, let me get rid of these lines. What I think we could see is a pullback to that former trend line before it bounces. Now look at what I just did right there. I drew a line in the diagonal fashion that represents the same type of angle we've seen in the past. Okay, got that? Same angle. Why did I stop right there? Well, there's a couple of reasons. There's a role reversal support level right here, right there. See that? I probably could have went a little higher, but I'll leave that right there. And the other thing is there's a good chance that that's the Fibonacci retracement level close to 50%. Now, I'm not going to get into the Fibonacci mathematical sequence here, But usually when you see a steep angle like that on any stock, even back here, see how steep this angle is? Generally, what you see is a 50% pullback right there to the midpoint. See, there it is. So here you have, again, another steep angle, all green candles. This actually could even be labeled more than 50%, but I think it could pull back to role reversal right there. And so with that said, I think you're in good shape for a short position. Now, was today the day to pull the trigger? I don't know. I would say no, but that doesn't mean tomorrow isn't the day. Why do I say that? Let me erase all these lines to clear this up. Who could answer the question right here? What do I need to see in this stock before I would even think about shorting it? Now, this might be an idea that you have to short it, but what am I ultimately looking for before I'm actually going to pull the trigger? Oh, there he goes. Paul got it right. Amalia got it right. Ken, you're very, very close. Well, I'll start with Ken, even though it was the last answer to come in. Well, there's a couple that came in after that. Spinning top or a doji, that would be a good idea. Spinning top or a doji, sign of indecision, usually found at pivot points. That's a good one. Lloyd says a red candle. Yeah, I would think so. A red candle would help. But here's the one I'm really looking at. Amalia, I would like to see a drop in volume, and I don't really care what color the candle is. That's the first thing I want to see is a drop in volume, because that'll signal that the buyers are getting tired. Another thing I could even tell you about is that there's a long stretch from the moving average, so that's a wide divergence there, and I think you could snap back. So depending on how you're going to do it, whether it be through a straight short position or through an option trade, you could buy a put, maybe a long-term put, sell a call spread, whatever. I would still wait for the drop in volume before I take any kind of short position, because a long green candle on higher volume is telling me that the buyers are still motivated. Okay, I hope that helped you out there. All right, Sean. All right, now Ron, go right along here, because I can see you folks are going to keep me busy tonight, and I have still have 28 minutes to go through all these other stock symbols. ARWR, and this is a pharmaceutical company. This is, to me, it looks like maybe they came out with the cure for cancer today. I don't know, but that's a pretty excited group of buyers that came in today on pretty high volume. I would say, looking at the chart, it's probably the fourth or fifth highest volume day of the year. So if you're looking for an entry point, you may be a little bit late on that one, because chances are news came out on this. Did they? I don't think they did. Let me see if there's any news. Arrowhead Pharmaceutical. They closed. They completed phase 1 in one of the studies. Okay, so news is out. All right, so that's exciting the buyers. But here's what I would suggest, Ron. This really takes a lot of patience. Look at the divergence. Remember that rubber band effect that I talk about all the time? The rubber band is stretched quite far from that moving average. The way news hits the market is this. There's a certain behavior pattern that you need to know about. Okay? On day one, all of those people who are monitoring the news and trading the market on a fairly active level will jump in on that news. Now, who does that leave? Who's left after that? Well, there are then the people tomorrow who will read the news who didn't get it today. And those folks may not be so much on top of the market, but they'll still get in and buy. So tomorrow you're probably going to see another high tomorrow, you see? And then on the third day, you get the procrastinators. So you might even see a little bit more. And then what happens is all of these people that bought in at 11 are now scratching their heads saying, should I take my profit at 14? And guess what? They do. And then it starts pulling back. So it's very risky to buy on a breakout of a high, especially after news comes out, because there's too much risk in that it would snap back on profit taking, short-term profit taking. So the best thing to do is to wait for it to gravitate back towards a sustainable support level before you get in. Now, I can't say what that is yet because it has not yet found any kind of support. Support back here is around 11. I don't know. I don't know if it's going to get all the way back to 11, but I think it could pull back maybe to 12, maybe even 12 and a half before it starts to bounce, and then that might be a better entry point for you. So hopefully that helped you out. Okay, now Paul says, okay. I'm wondering if that's a stock symbol or are you just saying okay? I'm just curious. Is there a stock? Sometimes we come up with really good trade candidates by accident. It's Oseco Gold Royals Limited. Okay. All right. It didn't come up for me. Maybe that's a foreign stock. But anyway, I guess just saying okay, Paul. All right. So now, who do we have next? Okay. So we looked at Ron's. All right. Now, Phil has no position in DIA at this time. All right, but he's thinking about buying puts, particularly leaps, on the diamonds for January 2019. Now, let me just pause right there, Phil, because technically the January 2019 puts are not leaps. Those are the January puts. The leaps are more than a year, more than 12 months is a leap. All right, so those options are going to expire in about 6 months. So those are 6-month options and not leaps. So if you're going to buy a leap, I would suggest that you try to go in the money. Slightly in the money is good the way you did it, but I would try to go further out. And I know they're more expensive, but you got to be careful. Now, I wouldn't do it this week either, because if you looked at how I analyzed the markets based on my weekly market report from last week, I think the markets could go up by the end of this week. You see? So I think you're putting yourself in a risk position by trying to buy a put, even though you might be willing to hold it till January 2020. You could wind up losing money initially on those puts. So be careful of that. I would wait. Why isn't my stock symbols coming up? Let me see. Hold on. Let me get that in there. It's not coming up. There we go. So I would wait for the market to start to pull back from an established support resistance level before you buy the puts. Okay, and hopefully that helps you out there. All right, now I'm starting to lose track because it's starting to get washed off the board here. Okay, tell you what, resubmit any stock. Joe, I'll get to yours. And if you could resubmit any of your stock symbols, please do that. And John, that includes you. I don't know where your stock symbol went. I know we talked. Oh, there it is. Thank you, John. Okay, so let's look at Joe. Joe, you just put in a stock symbol there, but I don't know what your intentions are. Would you be able to add to that maybe? Let's see. I have talked about Netflix. We own puts. As our subscribers own puts on this one from the option oracle. And if you look, I drew some fan lines on here. And so what's happened is we have 1, 2, 3, 4, 5, 6 fan lines right now. But guess what? This week, we can almost say that there is a 7th fan line going now vertical. After today's session, we now have a 7th fan line that is even more vertical than the most recent fan line. So the common sense behind this is that stocks cannot sustain vertical price movement indefinitely. It could do it temporarily, but it cannot sustain it indefinitely. Actually, I have to move this because I went to the daily chart. I'm going to do it this way. Go from here and up. So there's your 7th fan line. So you have 1, 2, 3, 4, 5 daily green candles in a row. And look down below. Joe, I think you know what this means. We have 5 green candles in a row, and the volume is successively lower on 4 out of those 5 days. That's number one. Number two, there's a long shadow above the candle from Friday, right? So that tells us the sellers are becoming more motivated. Number three, today's high is lower than Friday's high. Today's low is lower than Friday's low. So technically, you have a pivot point forming to the downside. My guess is that tomorrow you're going to see a red candle. I know that's bold and sounds pretty confident, doesn't it? But I'm pretty confident and I'm feeling a little bold to say that I think tomorrow is going to be a red candle on Netflix. I don't care how many deals the Obamas make and how many deals Oprah Winfrey makes with Netflix. I think they're going to have a red candle tomorrow. It has nothing to do with politics. I just think that the charts are telling me it's going to go lower and the buyers are getting tired. So let me just see. After saying all that, you're thinking about buying puts? I would go with that. I wouldn't try to buy cheap puts. I would try to go with a more expensive put in the money, maybe going further out. And then when the stock drops, you could turn it into a calendar spread and do really good things with it. Yeah, I think that's a great idea. And so that's my spin on Netflix. Okay, now Ron, ARWR. Did we look at that one? ARWR. Yeah, we looked at that one. So you're looking at the entry point. Okay, I kind of backed up too far on that. All right, now, John, here we go. I'm going to go with the first one you gave me, LRCX, okay? Because this is a stock. Let me see. I got to get the symbol in there first. LRCX. Because this is Lam Research for anyone who hasn't heard of this company. This is a stock that it follows the technical signals like a charm. This one has been around for a while, and it is a very popular stock for the option traders. We traded this one a couple of years ago. We did really well with it. And the signals that I would invite you to at least explore, or the signs, are the gaps. And again, applying the rubber band effect to the charts. Again, measuring the distance that the stock has dropped below that moving average, you'll notice that the distance it traveled in the past is similar to the way it is now in the present. So there's a good chance the stock is going to bounce and gravitate back. Now, it's a pretty expensive stock, so it becomes a little bit harder for the equity traders to trade this one, because you got to have a lot of money in the bank to be able to put up margin. Even if you're going to use margin, you got to have money in the bank. So the option traders could trade this on the cheap and still get even a better benefit than someone who's looking to buy the stock long. So that's my spin. The rubber band's being stretched right now. You have 2 gaps above the market. Right there is a very small gap, a gap down today. And there's a gap up here right around the 200, maybe the 199 level. So what does this tell us as far as entry point? Then we get into risk management. And then I'm going to talk about your exit strategy, all right? The volume is still maintaining. It's not going up, but it's maintaining a steady level. So that tells us that the sellers have not yet weakened to this point. All right, it's important. There's another little telltale sign here. There's hardly any shadows on this candle. Can anyone tell me what that means? If there's no shadows on the candle. Does anyone want to even take a guess at that? Well, I know someone's going to answer, but I'll let you type and then I'll answer it. We'll see if anyone is right. When there's no shadows, it means that and it's a red candle, it means the market opened on the high and closed virtually on the low. So if there was more time in the trading session, it probably would have gone lower. That's what that means. So I would think that tomorrow it's probably going to drop a little bit more. Okay, that's number one. So I would wait a little bit on that one, John, before getting in. But the good news is, if you're thinking about buying, is that the gaps will act as a magnet to the upside. So remember, that rubber band's being stretched. I would expect eventually a snapback to the moving average, maybe beyond, to fill the gap. But when that gap fills, I would be out of that one, because chances are, like all other gaps, even back here, when a gap such as this fills, the market generally goes the other way after the gap fills. Okay? Now, let's talk risk. The only other low that I really can see is down here at that low from back in February. You see that? So that's a long way down to be riding that position if you're wrong. And that's why option traders have it so much better than the equity traders, because an option trader could sell a put spread and pre-calculate what their loss is going to be even before expiration. An equity trader can't do that. An equity trader, the only place you have for an equity trader is to put a stop below that support level, because at any time it could bounce and form another and most recent support level, but it hasn't done that yet. All right, so that's that. Here, John, let me give you an example of how to trade the gaps, by the way. This is exactly what happened. I think I mentioned this on, when did I mention? I think I mentioned this in the video when I put out the weekly, the expiration week alert for our traders. Here's what I did. I make this very public because I don't want anyone to think I'm hiding the position. I have a very concentrated position in SLV. In fact, it is 100% of my retirement account. You might think this is crazy, and it goes against all forms of risk management for long-term investors, but 100% of my money in the retirement accounts that my wife and I have, 100% is in SLV. I am not looking to make a profit on SLV right now. I know that sounds crazy, but hold on, I'll tell you the rest. My goal is to parlay the position to accumulate more shares in the account, because I can't keep putting more money into a retirement account. You can only put in so much. So the only way to get more shares is to more or less swing trade it to accumulate more shares. So what happened is, on this day right here, I sold out of half my position. Half. Why? Because it hit and filled the gap. Now, it went a little bit further than that, okay, on Thursday, and it gapped up again. Can anyone tell me what that candle is? Can anyone tell me what that is? I know there's at least 5 people that know what that means. This candle right here that I'm highlighting, can you see that? That is a spinning top / inverted hammer. There's a couple of names you could tag on that. But this is a sell signal. This is a very clear sell signal. Now, even though that's a sell signal, I still didn't sell out of 100% of my position. I sold more. I sold another 25% of the original amount. And then what happened? My expectation was that it was going to fill this gap down here. Now, in my report to the option traders, they saw with their own eyes that I had a price alert set at 1560, okay? On Friday, my alert was fired at 1560. I then put an order in to buy as much as I could, okay? I bought all the shares back that I sold here. I bought those back, but I bought more shares. You get that? Because now I have the original money from the profit, but now that the stock is cheaper, I get to buy more shares. Now, because it's a retirement account, I couldn't buy back all of the shares that I sold on Thursday because, why? Because you have to let the trade clear to cash. But today, I was able to buy all the rest of the positions. So now I am 100% back into silver with many more shares than I had 2 weeks ago. You see? Now, look, I'm going to erase all these lines because I want to show you exactly what I'm doing. This is a gap down, and there's still a gap up here that needs to be filled. So I expect that the gap will fill. So when SLV starts going all the way back up here, I don't know how long it's going to take, but eventually I think it will fill the gap. I will then sell out of half of my position again and do the same thing all over again and read the signals. Now, if it breaks out of this resistance high up here, I'm going to hold off on selling anything at that point and continue to take a ride. You see? So that's how you trade the gaps. And if you look at LRCX, again, you can see that that's exactly the same way that you would treat this. Wait for a green candle, wait for the volume to drop. You could buy it, set your stop, but when the gaps fill, sell half the position. Or if you're so inclined, sell all of the position. And then from there, you'll have profit and more buying power for the next trade down the road. Now, with LCX, let me look at that one. Oh, LCX, what's going on? Is that a different stock symbol? LCX Semiconductor. Do you have the ticker for that one, John? LCX is not working for me. LCX. No, it's not coming up. Is that a Canadian stock? No. All right, I'll look. Oh, it's a typo. Oh, I see what you did. Okay. All right, so we were just looking at LRCX. All right, now let's take one more stock. Who wants to type in another stock symbol? I think I got most of them covered. Let me see. I think I got most of them covered. If anyone has one more stock, we can talk about that. Otherwise, I just want to highlight what's happening in. I want to highlight what's happening in Chicago. Okay, and no, we looked at Goldman Sachs. Okay, I'm looking. HZO. Okay, Ron. All right, Paul is look. Let me do two more. I could do two more. All right. So BR, and Paul is looking again at ticker symbol. This is terrible. My computer is really slow. Now, immediately I see a buy written all over it. But before you put the buy order in, let's talk about this first, okay? Within seconds, I can see a buy. Why? Because, number one, the stock has been in an upward trend. It is just ready to close over the 20-period moving average. But what caught my eye is this big, long green candle that is engulfing almost three of the previous red candles. So that is a powerful buy signal right there. If I were looking at this and my intention was to buy, I probably wouldn't wait past tomorrow. Because if it closes over the 20-period moving average, I'm guessing from the looks of the trend, it's probably going to set a new high. So I'm going to put a forecast on this one to do this. Now, notice the angle. See, it's not as steep as what I showed in the general markets. It's matching the angle from the previous upward leg. See, when you do that, it also gives you a little bit of a timeline and what you could expect as far as the stock setting a new high. Yeah, in the past, it's had some pretty intense upward moves, but then the rubber band gets stretched and it snaps back. But if you look, if the next upward leg follows suit and matches the angle from the previous upward leg, you can expect a new high to be made somewhere in the first week of July or the last week of June. You see how that works? So if you buy it, you want to put a target up here, watch the signal, see if there's any weakening, see if there's any long shadows above the market, look for the rubber band effect, all those things. But if you buy it, I would suggest you put your stop below this key role reversal support level right there. Form a resistance, once broken, turns into support. So if you buy it anywhere here, I would put my stop somewhere below 112. Okay, hopefully that helps you. All right, HZO, this is the last stock I'm going to pull up, and this is for Ron. And this is, Ron is looking for an entry point. Interestingly enough, this stock gapped down, and Ron, there's a chance that that gap could fill, but I'm looking at the characteristics of this stock. It has a tendency to have these wide gaps. You see back here, wide gap. This one gapped up, pretty wide gap up. This one is another gap up. It doesn't fill the gaps right away. So this one, although I think it could fill the gap, I wouldn't be surprised if it goes down a little bit more before going up to fill the gap. Why? Because there's still this magnet down here that could draw it down further. Okay. Now, I typically don't like to trade stocks that leave gaps open like that because it shows an uncharacteristic type of, I guess you call it a stock personality that I don't really feel I could depend on. So in order to really get a better picture, you got to back it up to a weekly chart and then play the gaps from the weekly chart. And I think you'll do better off. So what do I mean by that? Well, if you scan the chart, you'll see that there aren't very many weekly gaps that are left on the chart. You see? So number one, it hardly ever forms an open gap on a weekly chart. But it did this week. This is the only time in 3 years that the stock has gapped down. Now, with that said, it's giving me more of a reason to buy it with the intention of getting out at the gap fill point. And it might even go higher than that. So when you're weighing the evidence here, all right, Paul, Ron, rather, if you're weighing the evidence, I would lean more towards the buy side. And in doing so, I would be what's called a scale down buyer. This is not dollar cost averaging. This is just, don't exhaust all your buying power in case it goes down tomorrow. So buy some immediately tomorrow, but hold the rest of your cash. In the event it goes lower, you can buy the rest in until the gap fills. And that's just good sound strategy for you. All right, so we kind of ran out of time here. Didn't run out of stock symbols, thanks to all of you. On the weekend of July 23rd, I've been invited to speak at the Traders Expo. That's the Money Show promoters are putting on the Money Expo, the Traders Expo. And TradeStation is hosting me for that event. So I will be on their stage, and I will be talking about how to manage risk in the cryptocurrency market. I'll be using the cryptocurrency futures charts to describe what I'm talking about. I'll be on stage for about 45 minutes, and then I'll be roaming around, talking to some of my other friends that are speakers as well. John Bollinger will be there. I don't know if his wife Dory will be there, but Dan Gramzo will be there. These are Linda Raschke will be there. These are all folks I know or have traded with in the past. So if you find yourself anywhere near Chicago, I would encourage you to go. And even if you're out of state, I would look into getting a cheap hotel room. And cheap in Chicago. That's funny, isn't it? But I would try to get some flights and some hotel rooms and make a weekend out of it. It'll be fun. And maybe we can go grab a bite to eat or something, and then I'd love to socialize with anyone who's there. We can put a little group together. So if you are going, let me know so we could at least hook up that way. And if not, I'm sure they'll have some recorded sessions online that you'll be able to watch as well. So that's all I have for this month's Open House Q&A. I want to thank everyone for joining. Thank you for the symbols, questions. It makes it much more lively. And I hope you learned a lot today. I enjoy doing these, and I can only hope that you enjoy listening. So have a good rest of the week, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.